On the investment landscape in India. But I think the big question that everyone is asking right now, is there opportunity to make money in this mayhem? Sanjay believes that the valuations are still a bit expensive. Manish believes that perhaps there is still some downside as far as the market setup is concerned. But the question as to which are the areas where one can potentially make money, that's something that I'll try and decode with my panelists today. Let me welcome on stage Shiv Sehgal from Nuvama Capital Markets, Ashish Gupta from Access Mutual Fund, as well as Rahul Jain from Goldman Sachs to help us decode just that. Gentlemen, if I can have you on the stage, please. Hi, come. Hi, please. First up, thank you so much for being here with us at India Global Forum.
Thank you so much.
Thanks for having us.
Well, I wish it was in better circumstances because of late the capital markets, to say the least, has been really topsy-turvy. But we're talking about the long term, we're talking about the medium term and the way forward. So let me start by asking you, Shiv, does the investment approach really change in a VUCA environment like this? And I ask you that because usually someone will go with logic and rationale when it comes to making assumptions. But in the current scenario, it's possible that rationality and reality can stay in a bit of a parallel. What's the way forward?
So I think that's a great question. I think it goes without saying, if we just take historical precedent as to what happened, last few years in India, we emerged out of COVID really well. From an investment perspective, Indian markets rallied, and what we saw was a regime where there was high return, low volatility for a couple of years. I think the coin switched in September, October of last year, where we have been going through a phase, and it seems that we were entering a phase where there's going to be a low return, high volatility. Last few days would feel no return and high volatility. It's the nature of markets that you are not going to get both great news and great prices at the same time. If that were the case, I think investment would be a lot more easier. The reality is that I think, yes, it's very uncertain times. India has navigated, which I feel in the last few years, which was the first global reset. I think we are going through a second reset. Fast forward a few months from now, I think India will again emerge as the second derivative boost to growth that is very much required for Viksit Bharat. There is no denying the fact that my fellow panelists will also allude to the strong fundamentals and strong trajectory that India is on. We have very low debt. Our exports only are about 1% of GDP. From every metric, and I can relay many stats, the reality is that within EMs, if you look at what transpired even in the last few years, there was a reason why India was trading at a significant premium to the rest of the world. And I think that's going to continue. We went through last 6 months in a phase where, that premium kind of eroded. Valuations have corrected to a manner where there is a lot of incoming queries, I think, post this VUCA world in the next couple of weeks, next couple of days, where India will again, I think, re-emerge from this with the right beacon. And yes, there are going to be some bruises along the way, as we've seen in our portfolios last couple of weeks. But if we can come out of it in the long term without any major scars, I think that trajectory is not going to change.
Let's hope so. And that fast forward you talked about, really hope it's really, really fast forward because a day, is seeming very, very long as far as this scenario is concerned. But, to the point that even, Manish was making earlier, that Ashish, for now, we have only seen perhaps some valuation-based correction. The multiples have now come to 19 times as far as Nifty is concerned. But maybe the earnings cut hasn't been factored yet, and that's why there's perhaps more downside. Sure. Would you concur with that view?
So I think the market has this both on earnings and multiples, right? And again, 19 times is an average multiple and average multiple for the section of the market. If you look at many other parts of the market, if you look at the median multiple of the market, that is actually much more richer than 19 times. So I think there is certainly still potential for multiple compression. In fact, there's one chart that's I'm sure a lot of people would have seen on various WhatsApp groups that's been going. It's a chart of global uncertainty index, right? And the global uncertainty index is at an all-time high. It is higher than nearly 1.5x compared to what it was during COVID. It's nearly 2x higher than what it was at the time of GFC, right? And uncertainty really leads to higher risk premium in the market, and higher risk premium translates to lower multiples, right? So I think what we are going to see is continued derating across markets. As he alluded, we are certainly much better placed compared to our peer set, but there is going to be a global derating that is going to come through, even as we see potential of higher influx of liquidity into markets as some of the central banks turn more accommodative. On earnings front, I think jury's out. This year we started with about 18%. So FY25 market earnings was expected to grow at 18%. We are probably going to end up at around 6%. Many investment banks, I don't know if Goldman published their preview for the quarter, but some of the previews I've seen coming for the March quarter is forecasting 0 to 1% earnings growth for the Nifty. So I think there is potential for some more earning downgrade. Next year, the earnings forecast is still about 13-14%. So I think there is room for compression there as well. So definitely, I think we need to expect a period of more moderate return going forward, because as Shiv alluded, last 4 years we saw strong earnings growth as well as multiple expansion, right? And that drove returns. And I think we probably won't have that available in the coming few quarters.
Yeah, I think the market spoiled us over the last 3-4 years, where we were just used to seeing it go one way, and that is the upside. But, Rahul, we can't really, put it on just the tariffs in terms of the correction that I'm talking about, because even before these tariffs were imposed, there was this big exodus of FI money that was happening consistently for last many months. What explains that? And going forward, what do you think will be the key monitorable to watch out for that would perhaps result in a bit of a reversal in FI flows?
Sure. Thanks, Anisha. So I think to your first question, the sell-off picked up post-September because clearly we did not see economic momentum sustain. We saw right from start of last year, given elections and the heat wave, the numbers kept on getting cut. The consumption in India as a consumption economy was not coming through. The consumer companies were reporting, a subdued volume growth momentum. Credit growth momentum, etc., slowed down. There was a tightness of liquidity. So all those factors that could have supported the economy were against us, and there were headwinds emanating from there. Along with this, we saw China starting to bottoming out. Their real estate sector started to report less negative news. So second derivative was getting better. Chinese economy started, getting more traction with the government there willing to support the private sector. So clearly, the foreign investors saw a big gap up between the valuations of Indian economy with slowing growth, whereas China was, trading at a steep discount to where Indian markets were. So clearly, the money moved to the Chinese economy and some of the other markets elsewhere in the region. There was a US exceptionalism also that started, coming along the way, which also took away a lot of flows from the Indian markets. So clearly, I think we saw a lot of correction along the way. And that was not without any reason. Peak valuation, slow earnings. As Ashish rightly pointed out, I think this quarter would be, again, a very sluggish one. So therefore, I think it had to, play out. But thereafter, I think the government started, waking up to the fact. We saw in the Feb, the income tax cuts being given out, which was also, a right move from the government side, because this time around, the consumer balance sheets have been fairly leveraged. So this was the right move to give out 4, 5, 6% of the income increase through the tax cuts. We have seen the new regime at the RBI starting to support the financial markets with benign liquidity. More liquidity is being pumped. I think after a long time, we've moved into the liquidity surplus. So clearly the policy makers are waking up to the fact that they need to support the economy, which definitely starts to provide a backstop. But this came along as a big uncertainty. So therefore, what I say to your second question may not be true tomorrow about the key monitorables. I think for us, the key monitorable is, the upcoming first and the second quarter. First quarter is important because we're starting the financial year and there's an expectation of heat wave again. So does it impact the agri-produce? Does it impact the ground level jobs? We need to see that. And then, the second quarter onwards, we start getting into the festival season. So how does that play out versus the last year is also going to be an important variable to monitor. But having said that, at an overarching level, of all the major economies minus the US and the China, there are very few emerging markets that gives you a reasonable degree of real GDP growth, which is north of 5%, 6%. You take your number, we can say that 5.5%, 6% could be a probable scenario. Our house view for fiscal 26 is that of 6-handle GDP growth in real terms, even after cutting it by 40 basis points last couple of days. There are, of course, recession probabilities increasing in the US. Our house view is 45% recession probability. Like I said, tomorrow that number could be different, so don't hold me to it. But clearly, given that backdrop, a 5.5%, 6% GDP would entail 11-ish kind of a earnings growth for the full year.
Right.
Let's assume that we further shave it off. We're still talking about, let's say, somewhere closer to 8, 9, 10%. So there'll be some sectors that could be a good hiding spot within Indian economy. So if the local economy finds support from the policymakers and the momentum is not lost, so you control what you can control, and rather than focusing on the uncontrollables, and clearly what US does, what EU does is uncontrollable.
Yeah.
So I think so long as the policymakers stay put to that, I think we should be able to navigate it okay. But really it'll depend on sector to sector allocation, which the investors will have to take a view on.
Yeah, lots to unpack there and take it one by one. But to the point that he was alluding to, the China plus one factor and how, let's say, the Chinese economy bottomed out last year, and that's why the FI money went that way. But a part of the street right now believes that India could actually be a net beneficiary amidst all of this trade war, because while others have been punched with higher tariffs, we have been slapped with lower tariffs. So on a purely relative basis, we are likely to better. Would you concur with that, Shiv? And if yes, which sectors do you think stand out in better shape versus the rest?
So I think, let's put things in perspective here. The reality is that, just to allude to your previous point, yes, FIs have been selling, and this is probably the most common talked about theme in financial markets in India. The last few months, there's been an exodus of FIs from India. But if you look at post-COVID world, there was a world where Indian earnings grew at a 20% CAGR, one. Two, foreigners pumped in $50 billion. So there was earnings multiple re-rating, and as we, entered calendar year FY25, there was a reset where earnings had to reset to the multiples. And what the last few months or the last few weeks have done is they've provided a root shock to the system, and we've already been going through a de-rating, which we alluded to the first part. If you look at what is happening right now, and I'm a big believer of the flow of liquidity and how momentum is going to shift. There is about, and if you do the analysis, there is about 15 trillion of European assets, European money that is invested in US assets. There's about 20 trillion from Japan, there's about 5 trillion from Canada. If you see what's been transpired with some of these countries, is that they have said categorically that they don't want to invest anymore in the US and they want to diversify. That has very profound implications for India, right? There's a reason why within the EMs, India has been the darling. I will repeat, I think India will remain a darling, because what is going to happen is, if I'm only looking at 3 countries here, and you have about $35 trillion. Even if a small, minute scale of that has to come into from an asset allocation perspective in India, you're going to see India is not a very liquid market. Average earnings, average promoter holdings are on north of 65-70%. As a result of which, every time you see FI inflows coming in, combine that with any period where domestics are also pumping in money, there is only one way, which is you will see the market trend up. So that was the first part of the question. Quickly on your sector part, I think it's very clear that in the short term, domestic oriented sectors will do very well, right? But I would look beyond that. I think the way the velocity of input variables is moving, I think you will see the world evolve very fast in the next couple of days, couple of weeks. There was already a chatter last night that Trump is going to come out with a 90-day pause, and the market, rallied 6%. Of course, in 7 minutes, the tweet came out, nothing like that is thought is down, right? So the point is, it's going to be a lot more volatile. We have to adjust to that new variable, and by and large, go back to the thesis: strong quality companies, strong management, long-term thesis in India. India is going to go from 4 trillion to 7 trillion, right? Barring self goals that we can do, which we have done in the past. But I think a lot of things are realigning for India to be the golden bird again. And I believe in the trajectory for Viksit Bharat again. And I think things will play out far better. So stick to your core, stick to what you know, stick to where you have conviction. And I think, fast forward, things will turn out very well.
Okay, back to be the time of the golden era for India, and stick to what you know. So quickly, in the interest of time, Ashish, if I had to give you $100 right now, where would you invest that, and what would be your advice right now to retail investors?
So, I think it's very important at times like these, as Shiv said, that you need to be long-term oriented. You cannot react to news, right?
That's easier said than done in this environment.
No, because, sorry, because I believe that really this is not a time where you can react to an event. So just the other day, for example, when the first tariffs were announced, everyone thought the Indian pharma sector is a big beneficiary, and the second day it did not turn out to be true. Similarly, on tariffs, on relative tariffs, should you invest basis that, given as White House has stated, there are 70 countries where they are in trade negotiations with, right? So you don't know which way things will settle down. And these are only the first order effects. There are going to be multiple second order effects, because what has been announced is a seismic shift in policy, right? So there will be new geopolitical alliances will be drawn up. Will EU now align more with China? With Australia align more with China? So we really don't know how all this will settle. There will be second order effects in terms of what happens to the US economy. So it's not just about what happens to the trade, but as Rahul mentioned, there is 45% probability of a US recession, right? So, for example, Indian IT services is not impacted by trade, but why is it correcting? Because the probability of US demand going down has materially changed. So you cannot really take a short-term view and react to news at this point of time. You have to A, take long-term view, and B, be very diversified across asset classes. Right. I think one thing that has transpired over the last 4 years is investors have been too focused on only one equity class in India, that is equity, both because returns have been very good in the last 4 years, as well as taxation has been much more amenable, right? So I think you need to have a well-diversified asset allocation across equity, debt, precious metals,
can't forget gold,
right? So you have to have a more holistic view. I think that's the only way to manage volatility. One, have a diversified portfolio. B, have a longer-term investment horizon, because you cannot navigate the short-term volatility.
Okay, diversify and look for the long-term gains. That's the word coming in. In the interest of time, Rahul, quickly, just wanted to get a better sense from you. You talked about policymakers and what they have done so far. Do you think a lot more is needed from them? Just tomorrow, perhaps you're going to hear from the RBI. Is there a possibility of a 50 basis point cut instead of 25?
So look, I guess, sorry, thanks for that question. Look, I guess, going back to various such crisis period, it's important to revive confidence in the sentiments at the ground level. So I think clearly, I'm sure the policymakers' agenda would be full of items to address, but I think the immediate one is the Reserve Bank of India's policy, which is there this week. The expectation by the market is 25, but with what's going on in the global markets, can it be higher? The odds definitely are increasing. I think. But more than that, I think what is needed is the support, continuous support to liquidity, so that there is less volatility, less unpredictability in the market. Number one. Number two, there are certain sectors which have gone through sort of a corrective phase. For example, unsecured lending, which is a big focus over the last 2 years. It has self-corrected over the last 2 years. A lot of consolidation has happened. Can there be some more support there to revive the consumption lending in the market, possibly. So I think there are a lot of these things, and the regulators have taken those steps. I think you go back to the previous policy, they rolled back the risk weights on the non-bank finance companies, they rolled back risk weights on microfinance companies. So I think, that clearly shows that they want the real money to be pumped into the real economy. And if this continues, then clearly we'll find some support at the ground level in terms of the liquidity going out there. So yeah, there's always the need for more. I think important thing is whether those measures will help the real economy or not. I think that's where, if the focus is, it should serve well to the broader markets.
Yeah, that seems to be the bottom line from all of you guys, that the structural story of India is still intact. There might be that time-wise correction and the earnings downside that might be there, but overall, if you're looking at the long term, perhaps diversify your asset class properly and look at the long-term and structural stories rather than the short-term news, which he thinks that one should completely ignore. I don't know how possible that is, but thank you, gentlemen, for making time and speaking with us. Lots of us to think about. Thanks, Shiv, Ashish, as well as Rahul, for making time for us.
Thank you so much. Cheers.
Thank you.
Perfect.